What's going on, guys? In this video here, we're going to be covering Microsoft. We're going to be doing an analysis on this company. So let's load this up in the stock research tool. And it's been a hot minute since I looked at Microsoft. So putting it in the stock research tool, we're scoring this company a 9 out of 10. Now, what this software does is it takes the balance sheets, the cash flow statements, and the income statements, and it gives us a score out of 10 based off certain metrics. We're going to go through those 10 metrics in a moment, as well as we're going to go through these company metrics here, which compares the 5-year averages of the company to its trailing 12 months, so we can kind of gauge where this company is going and what we can expect, hopefully, for the future. So with Microsoft, we're sitting at $270 a share. It's been on a slight decrease, which gets me a little bit excited. And here we are with 9 out of 10 on the score sheet. We're only losing points in one area, and that is our 5-year PE average. We want to see this number underneath 22.5. Now, however, folks, that's not entirely bad news, because here's the thing. When you have a company that is growing quick, sometimes it can justify this PE ratio being as high as it is. However, is Microsoft that type of company? Well, we'll find out. But ideally, we want to find companies that have a PE ratio underneath 22.5. Going through the other categories here, we're pretty green across the board, and for good reason. Current ratio is sitting at 1.99. We want this over 1.5, and that means they have enough assets on hand to cover their liabilities. A high return on equity average, amazing EPS growth, a decent debt to equity. We want to see this number underneath 50%, folks, and we have that no problem, sitting at 40%. Share dilution is going down. That means they are buying back shares, although it's not an incredible amount by any means. They are buying back shares nonetheless. Now, with our net income, our free cash flow, and revenue growth, those numbers are all up. Our return on invested capital average is massive, folks. We are sitting at 20.32%, and our trailing 12 months category is sitting at 30.67. We want to see this number over 10%, folks. That's how this company knows how to make a great return on the money that's being invested. And for you as a shareholder, this is huge. So Microsoft is doing a lot of things right. In our company metrics category here, folks, if you just take a quick look, our average free cash flow is $40 billion. Our trailing 12 months is sitting at $63 billion, folks. We do pay out a really small baby dividend at 0.89%, which comes out to be a $16.5 billion of our free cash flow. Easily covered. Don't even have to worry about that. And look, they are about to acquire Activision. That was in the news earlier this year, if that was going to happen or not. It looks like it might happen. And guys, just take a look at their free cash flow here. They can just buy that company all in cash, pretty much. They're pretty stacked. They are pretty stacked up. This is a business that is incredibly solid. They get Activision, they have Bethesda, they are assembling a whole arsenal in the video game space. They are going to be a major player, a much more dominant player in this medium. And as video games become bigger, better, more cinematic, more involved, Microsoft will be paving the way, I think, in the next few years with the plays that they're trying to make. They are really pushing this forward. Profit margin is up over our 5-year average, sitting at 37.63% compared to 27.44%. They are up on a lot of things. They are crushing these numbers. This is a business that knows how to operate well. Now, what we have to try to do now, folks, with this $270 price tag that's attached to Microsoft, is that the right price to pay? Is that the right price to pay for such a great business like this? Sitting at 9 out of 10, folks, this is a phenomenal score. It's doing a lot of things right. They are crushing the return on equity. They have huge revenue growth, free cash flow growth, net income growth. They are up on their trailing 12 months free cash flow. They're up on their profit margins. They're doing a lot of things right. One would think that this company is unstoppable. However, does the price make sense? Is this a price that is fair? Well, in my software here, we have the price analysis section where we will put assumptions in to figure out what this company should be priced at and if it's overvalued or undervalued. We're going to do an analysis of 10 years. We're going to take a look at these numbers on this grid. I'm going to input my values here and I'll touch base with you in just a quick second. Okay, folks, so here's what I did. With my revenue growth numbers, I looked at the 1 year, a 5 year, and a 10-year numbers here, and I decided to give myself a somewhat of a discount. I want to approach this with a margin of safety because I want to see them beat these numbers. However, if we're able to purchase this business at a fair price with these lower revenue growth numbers factored in, that works in our favor. So with 10, 11, and 12, that's what I'm decided to go with. I did a slight haircut on our profit margin, free cash flow margin, sitting at numbers respectively that they can definitely hit with 24, 24.5, and 25. Free cash flow margin, same thing, 30, 30.5, and 31. Price to free cash flow, pretty much cutting it in half from where we're sitting at 31.83. And our PE ratio, lowering it down to 14, 16, and 18, something a little bit more manageable for where we want to be. That's not 27.96. Putting our desired return in, folks, take a look at this. Okay. So we are currently overvalued with Microsoft. Our average price to pay is $210. We're currently sitting at $270. We could potentially get there somewhere in this moderate category here. Ideally, I would like to buy somewhere in here just to give myself the most margin of safety as possible. However, these numbers would make a lot of sense. Now, at its current market cap right now, it's a $2 trillion company. These higher growth revenue numbers are not sustainable, folks. So you have to give yourself a little bit of a discount. And with these PE ratios and price to free cash flows, this company I don't think can justify, and as we discussed earlier on in the video, can it justify this high PE ratio? I don't think so. However, I'm willing to change my mind based off this whole Activision deal. Activision will bring another asset to this business. That's assuming it goes through, and it looks like it might very well be. So I might have to retract that statement. But nothing's confirmed just yet, so I can't say, and I don't know the future. However, how it stands now, based off what I have here on my research, and if you're enjoying this app, folks, and you're enjoying the video, hit that like button, hit the subscribe button. It means a lot to me, it means a lot to the channel. But this app here will be available to you, my viewers, subscribers, and it's so close to being released. Microsoft, as great of a business as it is, it's slightly overvalued. Now, we're getting Greene in our price to free cash flow scenario here. And 238, so 253 on the high side. It's not too far off. Now, if I just did 14% revenue growth, here's the thing, folks. Doing 14% revenue growth, we get Greene across the board here in our aggressive average. So you might want to factor that in. But once the app is out, you can put your own assumptions in and figure out what you want to make as your margin of safety. I like to go a little bit conservative and put myself in a predicament where if I'm wrong, I'm not wrong by too much. Anyways, folks, that's the video on Microsoft. If you want to see a company be evaluated, write it down in the comment box below. I look at all the comments, I read all the comments, I respond to mostly all of them, and I appreciate your love and support thus far in helping the channel grow and seeing where this goes. I can't wait to get this app out to you guys. I know you guys will love it. And remember, folks, we're trying to build a value investor mindset, and this app is geared towards value investors and new investors alike. So Microsoft, as it currently stands, not worth the price tag just yet. It's an amazing business, but one day it will fall into our wheelhouse, and guess what? That's when we'll strike and pick it up. So that's the video, folks. Thank you so much for watching. I will see you in the next one.